$22 trillion in assets. That is a stake in virtually every significant corporation on Earth. The next time you book a flight, the airline you choose, and even the one you didn't, they share the exact same investor. The next time you fill a prescription, the company making that drug and its three biggest competitors, same investor. Your bank, your phone carrier, your streaming service, even the store where you buy your groceries. This isn't a conspiracy theory. It's not even a metaphor. It's a structural feature of the modern financial system, and almost no one is paying attention to it. To grasp what's really going on, start with just one number and follow what it means. $22 trillion. That's the combined asset base of BlackRock and Vanguard, the two largest investment management firms in the world. To put that in perspective, the entire U.S. economy, the largest in human history, produces roughly $27 trillion in output each year. These two firms sit just behind that, but they're not building anything. They aren't drilling oil or shipping cargo. What they do is hold. They're the vehicles through which ordinary people, teachers, factory workers, retirees, deposit their savings into index funds and ETFs. The trouble is, what happens when you trace where that money goes? When you buy an index fund, the manager takes your money and buys a slice of every major company in the benchmark, every sector, every market cap, every single player, including the ones competing directly against each other. BlackRock is simultaneously one of the largest shareholders in American Airlines, United, and Delta. It holds a top 5 stake in JP Chase, Bank of America, and Citigroup, in Pfizer, Moderna, and Johnson & Johnson. Economists have a precise term for this: horizontal ownership, sometimes called common ownership. And quietly, without fanfare, it's rewiring the very logic of capitalism itself. The story of how we arrived here begins with a man named Jack Bogle and a bet that the entire financial establishment thought was ridiculous. In 1976, Bogle launched Vanguard on a simple premise: don't try to beat the market, track it. No star fund managers, no elaborate trading strategies, no promises of genius. Just own a small piece of everything. Keep the fees low and wait. Wall Street had a name for it. They called it Bogle's Folly. Then, 2008 happened. Actively managed funds collapsed. Hedge funds collapsed. Storied investment banks were wiped from existence in a matter of weeks. And Vanguard's passive index funds, slow, boring, almost mechanical by design, survived. What followed was the largest peacetime migration of capital in modern financial history. Trillions of dollars moved out of active management and into passive funds. By 2023, passive strategies controlled more than half of all U.S. equity fund assets, a figure that was effectively zero just 4 decades earlier. BlackRock, founded by Larry Fink in 1988, rode that wave into something that had never existed before: a single firm holding equity positions in over 17,000 companies worldwide. Some economists stopped calling it an investment firm. They started calling it a shadow government of global capital for years. No one stopped to ask the obvious question: if the same investor owns all the major airlines, does anyone actually have an incentive to compete on price? In 2018, economists Jose Azar, Martin Schmaltz, and Isabel Tecu published a study that shook the antitrust world. They analyzed airline ticket prices against patterns of common ownership across routes. What they found was hard to dismiss. On routes where competing carriers shared the same major institutional investors, ticket prices ran an estimated 3 to 7% higher than on routes where they didn't. Nobody made a phone call. Nobody sat in a dark room and fixed prices. The mechanism was subtler and, in some ways, more troubling. When the same investor owns your fiercest competitor, the pressure to undercut them, to steal their market share, to outrun them on price, it changes, it softens, because hurting them means hurting your own portfolio. The exact same pattern turns up in banking, pharmaceuticals, and telecoms. Separate research has found that companies with higher rates of common ownership tend to invest less in research and development over time, not more, because genuine innovation disrupts the entire portfolio, not just the single firm taking the risk. This is the hidden cost of horizontal ownership. It doesn't appear on any invoice. You won't feel it in a single transaction, but spread across millions of purchases, across every single industry you rely on, it accumulates. Quietly. Then came the politics, and they arrived from both directions at once. Every year, Larry Fink sends a letter to the CEOs of the world's largest corporations, not as a regulator, not as a government official, as a private investor, laying out his expectations on climate risk, social governance, and long-term capital allocation. And because BlackRock is a top shareholder in nearly every company receiving that letter, they read it very carefully. Supporters frame this as responsible ownership, using massive scale to push companies toward decisions that serve the long run rather than just the next quarter. Critics see it differently. One investor, unelected and unaccountable, with the practical ability to shape strategy across thousands of companies in dozens of countries. By 2023, the backlash had fractured along two separate fault lines, both alarmed, but for entirely different reasons. Conservative lawmakers accuse BlackRock of using capital as an ideological instrument pressuring corporations on ESG priorities that no voter had sanctioned. Meanwhile, progressive economists and antitrust scholars argued that horizontal ownership was slowly strangling competition, concentrating market power, while technically triggering no existing law. That last part is the real problem. Antitrust law was designed for a completely different world, one where the threat to competition was a visible acquisition, a hostile takeover, or one company consuming another. No one anticipated a future where passive investing, the most democratic, frictionless form of finance ever invented, would quietly produce the most concentrated ownership structure in economic history, without a single merger filing, without a single regulatory alarm ever going off. If you have a retirement account, and there's a reasonable chance you do, some portion of your savings is almost certainly managed by one of these firms, which means you are, in a technical sense, a partial owner of the very companies that set your airfare, price your medicine, and determine the interest rate on your mortgage. You are a shareholder in your own constraints. The architects of this system will tell you it was never about accumulating power. It was about democratizing access to the market, making wealth building available to people who couldn't afford a private fund manager or a stockbroker. And on that count, they're not wrong. But something else was built alongside it. Something that wasn't planned, wasn't named, and still doesn't have a clean legal definition. When the companies competing for your money all answer to the exact same shareholder, is the choice you're making really a choice at all?